This is Commodity Wrap. I'm Tony St. James. Our guest today is Brian Hoopes. Brian is with Midwest Market Solutions. And speaking of markets, corn market in the red, beans higher. Wheat market still under pressure, mixed day if trade for the cotton market. In some of our outside commodity markets, talking row crops here, canola, oats, rice, all lower. The softs were mostly higher, cocoa, coffee, orange juice, and lumber higher. Sugar remains under pressure, lower for the 8th straight session. But let's focus on the big ones here, corn, soybeans, and wheat. Now, I want to start with the wheat market, Brian. Because we saw a lot of pressure in wheat as we saw a rebound in some of the others. What's happening?
Yeah, wheat market is getting some rain where it needs rain pretty badly. Throughout the winter months, we noticed winter wheat ratings were down significantly compared to a year ago, and that's not a bad time to go in a dry spell. During the winter months when the crop really doesn't need that much moisture. But coming out of dormancy, that's when it needs moisture, and it's starting to get some. It's been a little bit of dry start to March, but the last week of March and early part of April have had some decent rains across the plains. Forecast for more rains across the winter wheat plains, really going to help out the wheat crop, and we should see ratings improve by next week. And again, maybe the week after, with warmer temperatures, plenty of sunshine, plenty of moisture, things are really going to grow and pop, and that's why wheat is planted in those areas, because of the rainy season. So there's some areas that it's going to be a little bit drier than desired. It seems like there always is, but with wheat acres at the lowest since 1919 this year, not a lot of room for error as far as this year's supply, but as far as stocks go, on Thursday morning we're going to have a look at our U.S. ending stocks. They're going to be very high. We're looking at some very high stocks numbers, and our quarterly stocks numbers told us we're not running out of wheat anytime soon, either in the U.S. or on a worldwide basis. So we have a lot of wheat to go through. If you just kind of look at that balance sheet and look at improvement in the crop that's expected, it's enough to push wheat lower here and probably below the $6 mark and get into at least the mid-5s before it's all said and done.
I guess this is also a reminder for us that when opportunities are presented in the markets, you really need to be ready to take advantage of those. We've had an opportunity here in the wheat market. We've had opportunity for corn, beans, and maybe it's an opportunity right now for cotton. Is that one thing to remember?
Yeah, I think you did a great job of reminding your listeners on TV and on the radio through the winter months that, these last year, during the month of February is when we made our highs in corn and soybeans. So it doesn't have to come in May, June, July. It doesn't have to have a weather rally. We can post our highs sometimes early in the year. And, you did a great job reminding everybody of that. We made highs here in the month of March in corn and soybeans and in wheat. And these could be the highs that we see for the entire growing season. Kind of depends on how many acres we plant, and of course how much we can grow during that growing season. But yeah, there's no reason to think that we're going to shoot a lot higher after we put in a big premium here for the grain markets because of global concerns, weather rallies around the world, energy prices spiking. And then you look at what's happening in cotton during this month. Here in the early part of March, we were at 68 cents a bale, hitting 76 today. We're putting in a premium, again, into some of these markets, making sure we plant enough acres. There's opportunities out there we have to be able to take advantage of and not just watch them pass away from this mid-70 level back down into the mid-60s.
Yeah, and two things that you have reminded me of. One, it's a futures market. It may not be reacting to what we're seeing on the ground today. Maybe the market did that earlier. However, there are other things that affect the markets that might not be fundamental to that market or even technical to that market, i.e. U.S. and Iran, but we've got a 2-week ceasefire. Was that enough to provide the impetus for a rally in the bean market?
I think
or at least a move higher,
yeah,
not a rally. Let me back up.
Yeah, pretty much a dismal rally. There's a disparity between the old crop and the new crop in soybeans. Originally when we were trading crude oil pretty closely, the bean oil really followed the market higher. Soybeans, old crop beans, followed the market sharply higher. We seem disconnected here in the last couple of weeks. We have beans, old crop soybeans trading near the lows that we had from the month of March, whereas new crop soybeans are closer to the highs that we had during the month of March. And those, up near those old highs, that is a place where I think you want to take advantage of. The soybean market feels like it wants to buy a few more acres before we start planting this spring. And we need those acres because of strong demand from China. That's expected. They're expected to double their inputs from 12 to 25 million tons next year. And then also biofuels mandates suggest we need to use and produce more oil products. And so, it's almost been a market that's led by soybean oil here recently. And that bean oil market has pushed to contract high. Soybeans have tried to follow it. But again, opportunities are around here for producers to take advantage of them as we get into the spring planting time frame.
We're talking with Brian Hoopes. Brian's with Midwest Market Solutions online at MidwestMarketSolutions.com. This is Commodity Wrap. This is Commodity Wrap. I'm Tony St. James. Our guest today is Brian Hoopes. Brian's with Midwest Market Solutions. Brian, it's been an interesting day. And I guess, after Thanksgiving till somewhere in till that WASDE report in January, we didn't have many interesting days. So I guess if you just sit around long enough, the market will move from not very volatile to very volatile. And over the last month, we've seen a lot happening with that U.S.-Iranian situation. We've got a ceasefire now, and that's pulling the energy markets lower. WTI, RBOB, nat gas, ultra-low sulfur diesel, heating oil, all of those pulling back while the equities have been rallying, and big rallies on Wednesday. Pretty interesting to watch. What are your thoughts here?
Yeah, it's definitely impacted our cattle markets, I thought, today, with energies dropping sharply, equity markets rallying sharply, gold and silver rallying sharply. There's already some conflict or cracks in this armor of this trade agreement. We mentioned this morning that, we're not at the end of this trade agreement, we're at the beginning, and so things have to be worked out yet and hashed out, and there's already points back and forth where both sides are bickering about the other side already. So we're a long ways from having this signed, but at least we have a ceasefire for the next 2 weeks. And so that's why I think you saw the energy markets fall so sharply in the overnight, reacting to this news, a lot of headline liquidation, algorithm-type trading. But since then, we've stabilized, and we've traded in kind of a range between 92 to 95 in that May crude oil contract for most of the session. And the market maybe needs to kind of consolidate, bide its time to see where we come out at with a lot of this agreement in the next 2 weeks. And until we have that finalized, we may not have a lot more big moves. Maybe the big move is behind us, but it has sparked a rally in the equity markets, and that helped our cattle markets to rally today. We see April being the upside leader. We've turned the calendar to April, and options went off the board. Deliveries have started. There's no deliveries, probably not much of a threat of one at this point in time, and it looks like the cash wants to move higher. Numbers are really tight. The show list numbers have dropped off even further, suggesting that for the packers who are increasing their kills, part of it is because of Greeley, Colorado coming online, but their kill yesterday was the largest in 2 months. that bigger kill means they're going to have to bid up a little bit more to get this inventory, and hopefully the box beef can follow along with this higher move, but so far that has not been the case.
I'm glad you went there, but pork going the opposite direction. Any thought on the hogs?
Yeah, that hog market has been one that is, I think, disappointing for a lot of producers that it couldn't hold those summer highs. When we were up in that 110 to 112 area, we thought maybe that was just too much premium, too rich of a premium for the markets to keep, and it's pulled back now into the mid 104 areas. It seems like it does seem to find some support in the 103, 104 area. I wouldn't be surprised to see us maybe consolidate or trade sideways in here as we go into the spring, and maybe demand starts to pick back up and give us another chance to get back in the 108 to 112 area. But to get anything above that, it would take, I think, a really huge demand trend, and I'm not sure that is in the cards.
All right, Brian, if we want to learn more about you, about Midwest Market Solutions, maybe carry on a conversation, where do we find you?
You can find us on our website, MidwestMarketSolutions.com, or you can give me a call, 417-501-5132, and we can talk about markets and any strategies that you might be interested in looking at.
He's the president, Midwest Market Solutions, Brian Hoops, on Commodity Wrap.